Welcome to Australian Secure Capital Fund's investor presentation evening at the Stamford Hotel. Beautiful, beautiful surroundings. Thanks for joining us. Tonight's, I like to think of it as a little bit as a behind-the-scenes look at Australian Secure Capital Fund, but let me introduce myself first. My name's Peter Orbord. I'm the chairman of the compliance committee for the company, so I'm a little bit internal-external in that sense. I'm an external member of the compliance committee. I don't work as an employee of the company so much as a consultant to it. Phil and Richard asked me today to MC the evening tonight, so welcome. As chairman of the compliance committee, the first thing I should do is put up an enormous disclaimer and let you know that what we talk, as always, what we're talking about tonight is just general advice. We're not taking into account your personal circumstances and the advice, or the general advice. We talk factually about the company and may or may not be suitable for you. That's your decision. So tonight we're going to hear from Richard Taylor on my left, who's the CEO of the company and a director. Founding director of the company. So Richard's going to take us through a bit of the workings of the company. It's really important to us that you understand how the company works, how the funds work, how the money is invested across the different funds, and Richard's going to give us some insight into that. We're then going to go into a question and answer session with three of the directors and Joe Bennett, who's a senior executive with the company. And that's your opportunity to ask any questions you might have about the workings of the company, anything in Richard's presentation or anything really. So have a think about that as we go through the presentation. If anything comes to mind, make a note of it for that Q&A session later on. After that, we'll be hanging around just for some drinks and dessert and a little catch-up. And so there's a number of people from Australian Secure Capital Fund identified by these snazzy badges here with their names on it. Some of those people you'll recognise as people you're speaking to every day in investor relations, but other people are just drawn from anywhere within the company, admin, compliance like me. Our legal counsel's here tonight, so feel free to grab any of those people and say good day and have a chat. So I thought I'd just start with a little snapshot of where we're at, where the company's at. And that big graph on the right there, funds under management, is interesting. We're looking back just the last 2 years of the company, and you'll see a fairly linear growth rate there in funds under management. That's combined for all funds in the company. And, back in February 20, I think the whole world was pausing and wondering, what was happening in a macroeconomic sense, and as were this company. And history now tells us, anecdotally, that things soldiered on. After a little dip, we see that dip, and we look at the hesitation in markets across from investors and even from the borrowing side, and then after that it just picked up strong, and that linear growth continued on. And it's indicative of two things. One is investor demand for competitive interest rates, and indicative of borrower demands on that demand side of the equation for good finance options, good easy finance options. The other thing I found interesting in these statistics was if we look at the value of, I need my glasses for this, the value of settled loans as a function of total funds under management, you'll see that number of 350 million as against 150 million of funds under management, which is telling us that the loans are turning over 3 to 4 times. These are short-term loans, and Richard's going to talk about that, but it's a key component of why this fund works so well, and how the risk profile of the fund is delivered. It's a really unique scenario for Australian Secure Capital Fund. So, with that in mind, I'm going to hand over to Richard Taylor, who's the CEO, founding director, and the current CEO. Richard.
Thanks, Peter. Firstly, good evening, everybody. My name is Richard Taylor, the CEO and the Director of Finance at ASCF. Joining me in the room this evening is Phil Shacker and Costa Giovannis, my co-directors, who many of you have spoken to outside, together with the majority of our staff here in our offices in Milton. I appreciate it's a cool evening outside, so we do thank you for turning up this evening to hear as to what we have to offer. Pete gave you a quick snapshot of where we are, but I'd like to dial back and tell you how we started, what we do, and what we consider the opportunities ahead of us. Before we do that, I think the audience is old enough to join with me if we cast our minds back probably 20 years when it appeared that every lawyer in southeast Queensland operated a solicitor's mortgage fund, promising borrowers that their name on the title would be the be-all and end-all. And I think we all appreciate that probably wasn't necessarily the case when some borrowers realised that they were the proud owners of a strawberry farm out at Murgon, or perhaps were second mortgagees behind a major bank on a high-rise in Roma that didn't even exist. Well, thankfully, the industry has cleaned its act up considerably since those days, and there's been many, many changes, mainly due to legislation. So Australian Secure Capital Fund is an ASIC-regulated pooled mortgage trust. We hold both an Australian Financial Services licence and a credit licence, both which were granted in 2016. In essence, we offer first and second mortgages registered against property. Unlike a lot of cases whereby the funds are held, or the investors' funds are held directly in the company's bank account, we use a third-party custodian that holds all our funds based out of Sydney called Certain. And whilst they operate under our direction, certainly we don't have access to the account itself. Many of you may have jumped on our website and seen our figures. We provide those as a 6-monthly when they're updated. And in all cases, those are audited by Grant Thornton, who are our auditors here in Brisbane. So Australian Secure Capital provides its funding to borrowers mainly through a couple of the mortgage aggregator panels. That's been another change since the global financial crisis, that the tightening up of access to credit and has meant that mortgage brokers generally needed to be further educated and further accredited, and the aggregators themselves were responsible for that. We're lucky this evening to have Julian Wills from Finshaw, who's head of compliance there, joined us to hopefully answer any questions on the lending side generally in the open market at the moment. So what does Australian Secure Capital offer? Well, we offer a monthly return to investors paid from income received from a pool of loans, and I will expand on that at a later stage. But if you cast your mind back to those solicitors' funds where you, the borrower, were also on the title, that meant generally that if that loan went bad, you were responsible for that, and the solicitor did the right thing by handing you the title, probably giving you the keys to the house and suggesting you drive out and see where your security was. Certainly with us, it's a pooled effect, which means no investor's money is indicated on any single individual loan. All those loans are secured by registered mortgage, so we only lend on freehold title. We don't lend on leasehold land, islands. Some of them I wouldn't mind visiting, but certainly we don't lend them or take them as security. And loans generally, as Pete touched upon, are short-term in nature, so between 1 and 24 months. They're pooled across an entire book to minimise the risk on any one loan going bad. So ASCF offers 3 main funds. Our Premium Capital Fund, which provides first mortgages only. It goes to a maximum of 70% of the property value. And in all cases, we must have a registered valuation on file. We will look at terms of up to 24 months. And as we go through these slides, you'll see why we're a short-term lender. And that particular fund, and certainly by all means, feel free to stay around afterwards if you have any questions on the spread protection element of that fund itself. Our second fund is a select income fund, and again, operates on first mortgages only, but a shorter term to a maximum of 12 months. We will go slightly higher in regards to the loan to valuation ratio, But again, anything over a 65% loan to value, we do require a written valuation. The third fund is ASCF High Yield, and I know there's some investors in the audience this evening who have invested in the High Yield Fund. It does a combination of both first and second mortgages, again over a maximum of 12 months. And very similar characteristics to ASCF 1 in that we'll go to a maximum of 80% of the loan to valuation, and also, again, requiring a full valuation on loans greater than 65% of the property value. So within our funds, we operate as the responsible entity, we operate a discretionary reserve account that covers all funds. And that's a requirement that in the event of a loss that we can call upon those funds. The spread protection, which I called upon or mentioned earlier on in the Premium Capital Fund, is there in that fund. And again, by all means, please stop around and ask questions on that at the end if you wish to. The fast turnaround probably sets us around from other lenders. We can turn an application around in 2 to 3 days, because what you have to consider is that, and we'll cover this in the slides shortly, that we're looking at the quality of the asset, not necessarily the ability by that borrower to service that debt. And our rates are obviously considerably higher than the standard housing rates, starting from 8.95%, going up to just under 15% by way of a second mortgage. So I guess in the criteria that we look for, what do we look for when we assess a borrower and a borrower's application? We're looking at what the loan purpose is, and we'll cover off on a couple of examples in a minute. But the main thing that we're looking at is the quality and location of the security property. I flippantly mentioned the properties out at Murgon and the other side of Toowoomba and the regional properties and a lot of the rural land that a lot of the solicitors' funds used to get in trouble lending against. Well, certainly we lend in regional and rural areas, but it's all based on the quality of that asset. I think we'd been rather naive in the current climate to think that the capital cities were the be-all and end-all when it came to price and quality of property. And we've certainly seen over the last 12 to 15 months that the regional areas have enjoyed extreme growth, and a lot of the smaller towns have certainly become bigger towns. One of the main criteria that we look for is how the borrower is going to get out of the deal. I think if you just saw the interest rates that we charge, you'd see that's not sustainable on a long-term basis for a borrower. So in most cases, and we will cover the examples, we're looking at how the borrower is going to exit from us. And probably the last important criteria is the loan to valuation ratio. And what that means is we look at how much the borrower is wishing to borrow as a percentage of the property that we've had valued or the security that we've had valued. And we can then assess and weigh up the risk that we think whether this loan is going into default. Obviously, on a lower loan to valuation ratio, the borrower has more hurt money in way of equity in the property, so certainly has more to consider. But I guess the final criteria, and it's a lot of things that traditional lenders don't consider, we ask ourselves, will the borrower be better off after they leave us? Okay, so we've covered what we do and what we look for. Obviously, there are a lot of things that we don't do. And certainly we don't do loans for unlawful purposes. If you cast your mind back, and still currently in the current climate, a lot of major banks will allow you, and many of you in the audience here may have approached your major bank to see if you could withdraw some equity or have cash out. Depending on the amount that you require, there's still many, many lenders out there that don't ask where that money's going for. In every occasion, we want to see some form of evidence as to what the money's being used for. The other thing which we don't do is we don't do traditional construction loans. Now, I guess many of you may have attended other similar webinars, seminars, information nights, whereby they've stood up here and told you that the next best thing is the local development and the high-rise building. Well, let me tell you, from experience, there are considerable inherent risks in construction. What sounds good on paper to start with doesn't necessarily, when it comes to an end, is realizable. So we certainly don't do construction lending. Now, that's not to say that we won't lend on the value or the as-is value of a property that's under construction, but we certainly won't lend on the construction basis. If you've got other assets that you want to provide as security, and the money is going to be used to complete a construction whether it be a single dwelling or a block of units, well, we'll certainly consider that, but that is not the prime security that in most cases we're going to take. And again, loans where there is no evidence or clear evidence that the borrower can or in this case, cannot support the interest payments. We're an asset lender, so we look at the quality of the security, but we also look at the likelihood of that borrower being able to support that loan in the event of it not being repaid on time. We're all aware of, and again we'll cover these examples off shortly, we're all aware of borrowers who tell you that their property is going to sell in 3 months, and we all know that after 3 months they haven't even got it listed for sale. So we want to be able to see that a borrower can quite clearly, if required, support those interest payments. Now, that doesn't mean that we require the traditional forms of identification. If a borrower approaches us and hasn't completed his 2020 or 21 tax returns, we're not going to ask for those. But we're certainly going to want to see other forms of evidence, whether it be bank statements, and get comfortable around the fact that that borrower is going to be in a position to service that debt if he needs to. Finally, we won't do something where there's no exit strategy. We get a lot of applications in from borrowers, small business, and we'll cover that in a second, who all believe that the business is going to go on forever. They founded this business, it's going to be a glaring success. And we usually ask them, well, so where will you go from us? And if the borrower says, well, I'll probably just keep renewing with you until I've got sufficient tax returns to be able to move on, it's probably not going to be a loan for us. We're going to be able to see that you can move on to a traditional space given the appropriate period of time. So again, the same comment that we made earlier, will the borrower be better off after they leave us? So why has there been such a growth of demand of this type of finance? Well, again, we cast our mind back 12, 13 years to the global financial crisis, and we had many of the major banks on an asset loan basis lending to 90 and 95, or in some cases in excess of the property value, to 105% of the purchase price or value of the security. And we all know what happened in 2007 and 2008. Consequently, a couple of pieces of legislation were passed, and the major lenders saw that their movement forward was to focus on traditional mum and dad home loans. The private elements of a lot of the major banks also decided that they would look after the big end of town because that's where the bigger loans were enabled to be lent out. And the small business owner, especially when he was starting out, was left out in the cold. So we see many, many applications from borrowers who maybe only have 12 months of trading history. They don't have enough evidence to be able to go to a major bank straight away. So they just need some help or assistance in getting over the next hurdle. And again, if the quality of the asset, and that asset has to be owned by the business owner or his spouse, if the quality of the asset is sufficient and the business plan is acceptable, then certainly we're going to give that borrower an opportunity. So why use a private lender? Well, as I mentioned, speed of service. One of the big things that we can do is turn around the deal from application from start to finish. And certainly we're finding that at the moment with a very hot housing market. People want to list their property for sale, but they want to buy somewhere before they can do so, and they've got two different contracts. In some cases, it may be a matter of raising the deposit to put down on the new property and take a chance that their own property sells. Well, we all know that it's a chain effect, so if your property doesn't sell or settle in time, then you're limited to the one that you can purchase. So turnaround speed for us is imperative. We can certainly have our panel valuer provide a written valuation and back to us in a matter of 48 hours, even if that's not in a formal written form, but we know it's a verbal confirmation and it's coming. And we can then prepare legal documentation from our solicitors down in Sydney and certainly settle in a 3 or 4 day period. The other big one is cash flow. We see this all day long. And to be honest, COVID has probably pushed this out even further. Small business is waiting for other small business to make payment on invoices outstanding, but means that it can't grow its own part of the business because the lack of receipts. And we know that these are timing issues or capital reductions. So I appreciate the small print is there. And by all means, there's copies of these slides, I believe, in your presentation pack, and certainly on the USB sticks that everybody's got or more than welcome to take home. But this is a couple of typical true examples. This one is up near me on the Sunshine Coast, where a borrower, again, was looking to purchase another property. And we think it's hot in Sydney. We think it's hot in southeast Queensland. Well, Sydney and Melbourne prices are even hotter, and properties are moving even quicker. And unlike here in Queensland, you don't get necessarily the protection of a subject to finance clause that you do down here. Certainly down south, exchange takes place a darn sight quicker. So this particular borrower had seen a property that he wished to purchase and wished to have under contract, but hadn't sold his own property first. So we take security in this case of both properties, one that he owned outright, and provided funding for the new acquisition. He then obviously sold the property and paid us back out of the proceeds of the second property that he'd sold. The second good example, again, and these are accurate cases that anyone who looks on our website can see, we have a list of loans there as well as the audited accounts. Phil is quite due diligence with our compliance team that we are quite open and transparent, that you can go onto any of our loans and you can see the location, I believe, the suburb. You can certainly see the value and how much we'd advanced against that. So quite transparent in that respect. So you probably find this one on there. This was a particular case down on the Gold Coast 6-9 months ago, whereby a small car business had a contract with one of the big insurers to do their panel beating work. And as we expect every summer in Brisbane and the southeast, we had a hailstorm, and needless to say that small car business was inundated with vehicles that needed repair. But that's all well and good, but you and I know that you may order equipment and you may order supplies and you may take on additional staff, but they're not all going to wait 60 or 90 days to the insurer to pay you. So we funded this matter by taking the director's property as security, and again, when the funds came through from the well-known insurer, that loan was repaid. We seem to have chosen 3 examples on places I know extremely well, and I don't know why. But the third one out is actually out at Warwick. I have some land out there myself, but this particular borrower approached us that he had funding with a traditional bank that wouldn't extend that funding because of the location of the property. It just so happened that I'd actually been out to the site very similar to my own site, which is only around the corner, and my friend of mine who runs the agency side knew this site inside out. So we were quite happy to roll out this developer who'd land banked about 45 different lots. In the main had sold a lot of these, but needed to move finance from one lender to another. Just otherwise he was going to be in default or term default of his existing loan. And slowly what happened is that developer has subsequently sold these properties and reduced that debt. He has subsequently come back to us on 2 separate occasions for additional funding, because it was a darn sight easier to deal with us than it was to go through the rigmarole of going back to every single bank he could think of and see if they would be interested in the security. So these are real life examples, and I guess there's people in the audience here who perhaps maybe have sons or daughters who've tried to go and get traditional style finance. Maybe it's releasing equity from a property that you own. And you'll see the turnaround speeds of the major banks these days. And without mentioning some names, I mean, we're looking at 30 and 40 business days to get to an assessment. Well, if you're a first home buyer and you've signed a 30-day contract in Queensland and your parents have put their property up as security, I can guarantee you one thing, that you won't be drawing loans down from that particular financier, which consequently means that you're in default, and there's consequences that go with that. So we start to see this day in, day out. The banks have offshored, in a lot of cases, a lot of their decision-making processes. We start to see timeframes blow out. We've all seen cases on the news where the banks have closed their regional branches and then tried to reopen them rapidly when they thought it was a good idea. And then COVID struck and they closed them again. And I think the one thing we did learn is definitely do not follow the business model of the major banking institutions. Again, I apologise for the small print. It's certainly too small for me to read from here, let alone people in the audience. But it gives you a bit of indication as to the weighted average across all our funds. As Pete mentioned to you, certainly seen a rapid growth in fund development over the last 6 to 12 months after that initial COVID spike. And I guess very much people were unsure as to what was going to happen worldwide, let alone where they should put their money or their investment return. We've seen, as I say, a considerable increase in a rate of return across all three funds, and I'm sure in the question and answer session I'm happy to break those funds down in greater depth if anyone needs further explanation. We're a Queensland-based organisation, head office here in Milton in Brisbane. Those of many of you may have come to our office across the road from the Eiffel Tower. That's our office at 33 Park Road. And consequently, you would expect that the majority of our applications are based here in Queensland. In saying that, I did mention earlier in the opening slides that we're on 2 or 3 of the major aggregator panels. So that means that we get the opportunity to go down to a lot of the professional mortgage broking development days, provide information to their brokers as to the services that we offer and the lending that we look at. And consequently, as you can see, there's other than I think the Northern Territories, there's a pretty even spread in the 3 major capital cities, capital states in New South Wales and Victoria, Tasmania and WA. Again, just because of location-wise, it's a lot easier. And in some cases, we do drive bound to look at the security of property itself. So certainly, Queensland has an increased percentage. The 3 of us I mentioned, and certainly will be around later if anyone wishes to have a conversation with anyone. Joe Bennett is also our senior executive. Joe's been with all the major banks, saw the worry of his ways and moved over to us a couple of years ago, and he's still here, so I assume that he doesn't regret that. But Joe's got plenty of commercial lending experience. Anyone who's got any questions, I'm sure he'll be happy to answer. That about wraps up the brief slide presentation that I've got. I'm going to pass you over to Pete now, and I think he's going to chair a bit of a question and answer session. So on that note, thank you very much indeed for coming. I hope you will stay with us and join us for some drinks and some nibbles afterwards. And on that note, I shall pass you over to Pete. Thank you, Pete.